Hi, and welcome to our session on voluntary protection products. I just want to give a thank you out to Fortegra, the sponsor of this session. And I'm Matt Kownacki with AFSA. I'm joined here by Paul Metrey with the National Automobile Dealers Association and John Short from Fortegra. We'll get started right away. Thank you for joining us. So we're talking about voluntary protection products. These are enhancements that consumers can elect to purchase along with a loan or other type of lending contract. So, John and Paul, what makes it that these products are coming under such scrutiny now from the federal government, state government, and even consumer advocates? Paul, we'll start with you.
Well, consumer advocacy groups, and let me just start out by thanking AFSA for the opportunity to join the program, be with John, and talk about this important topic. Consumer advocacy groups have long disfavored voluntary protection products. They have really taken a number of attacks at them over the years. You see that in the media. You see it really in the form of, from governmental agencies, enforcement actions, and also other types of reports that go out. So this is something that's not new. It has picked up in intensity, and really they seem to have problems with a number of different aspects. They certainly have problems and concerns with pricing. They have problems with things such as refunds. Certainly transparency has come up. So there's a number of aspects of it that they disfavor, and they've called for changes to. And again, we've seen that through enforcement actions and reports, most notably from the National Consumer Law Center. They had a rather extensive report on this in 2017. So the focus is ongoing, but certainly we think it's picked up quite a bit.
If I would add, on the one level, enforcement actions have gone down over the last, I'll say few years, particularly at the CFPB level. You've seen I think the sales practices were tightened up across the industry, so there was a better awareness. The products themselves were never really the focus of the enforcement action. It was making sure the disclosures, Reg Z and so forth, are properly followed and the products were accurately described. I'd say the other dimension to this is voluntary protection products are coming into the public policy debates is through the all-in APR caps. So it's another way of consumer advocates trying to limit the availability of lenders to offer the products to consumers by creating one, the interest rate cap, and then two, by having the APR calculation include the cost of the products. Products are independent and separate from the cost of credit and really should not be in an APR calculation.
Great. Go ahead,
yes,
Paul.
I would just build on what John said on that last point about the all-in APR calculation. That is really a bankrupt concept. It is something that does a disservice to consumers. Let's recall why the APR was created. It really is supposed to be a common metric for comparing the cost of credit in a percentage form, so that when people do shop for credit, whether it's mortgages or autos or anything else, they have a means of comparison. And it's really supposed to measure just that, the cost of credit. When you start putting into it premiums for other products, it distorts what that figure is. And of course, many consumers are not going to know the difference between an APR and an all-in APR. And of course, if you put the premium for other products into the finance charge, naturally, it's going to create a higher finance charge and a higher APR and make the product appear to be less attractive, even though there's additional value that comes with it. So what the Federal Reserve Board has done over a generation and other federal agencies in really branding the APR to help consumers understand the financing process, this entire initiative does a real disservice to that. It undermines consumer education. It does not enhance it. And it really creates a problem for the consumer to understand really the cost of the product that they're seeking. So for that reason, it really is something that should be resisted. It is being resisted, even though it has made some inroads, we know, at the state level.
That's right. And we are seeing all-in APR proposals at the state level, even federally. And I think, one thing that you alluded to, an additional wrinkle at the state level, is that you now have a disclosure of the federal Reg Z APR and then you have the state level APR, and they may be different. And I think, one thing that we've tried to highlight in our efforts opposing all-in APR is the confusion that these two rates would cause when disclosed to the consumers.
I think that's right. I think even if the all-in APR rate is not disclosed to the consumers, even if that is simply something that you cannot exceed as a creditor, you still get into a lot of challenging issues. I mean, you're running two calculations, what plugs into it, what does not, how is it handled? So on multiple levels, it's problematic.
Okay, let's move on to the value of these voluntary protection products. We know that a lot of the scrutiny comes from consumer advocates saying that consumers pay for these products and don't get value out of it. What can we as an industry do to allay those concerns and really highlight the value that consumers do receive?
So, Matt, I'll take the first swing at this one, if you don't mind. And I did put together a couple slides, so we'll see how my ability to actually work the technology here. So give me 1 second and I'll pull up a couple slides to walk through this. So this first slide is showing unemployment claims that have been submitted during the pandemic. If you look over time, since 1970s, we have never had more than 1 million claims filed in a given week. Back in March, it exceeded 3.2 million in 1 week. And then here you can see the kind of the time series over the last couple months that the weekly averages, it went up to 6.9 million that week of March 28th. And it's continued to exceed 1 million through August. So what you have here is an unusual time, obviously, and you had widespread unemployment across the country. So it was a common factor that drove it. And so where this takes me is, what does it mean for a voluntary protection product? So one of the products we would sell through lenders is credit involuntary unemployment insurance. So this is our claims that show number of claims paid and dollar amount, as well as claims submitted and the percent increase this year compared to last year, assuming last year is a relatively normal year, nothing unusual happening through this time period in the employment market. So as you can see, as the unemployment claims and people were unemployed due to the pandemic, the borrowers would go in and see their lenders, and that's when they say, okay, well, we need to make sure we have arrangements, and the lenders say, well, you have unemployment insurance on this through Fortegra, and you should submit a claim. So here you can see consumers know they have the product, and it's filling the need when they need it most. So they're out of work, they don't have income coming in, and the benefits of the unemployment insurance is it pays your loan during your period of unemployment. So that's, I think, a key point. And then the one other thing I would add is if you look at it, and this is recent data from May that was updated, and the Fed Reserve's finding says basically 37% of Americans can't afford a $400 unexpected expense. So these products are designed to address consumers who are unable to insure by themselves and they need protection. They don't have the savings or resources, or they're uninsured or underinsured. So having this type of voluntary product serves a need, protects a consumer when they need protection the most. And you can see, based on claims activity, this performed as you would expect when people are unemployed. And here we have a spike, and it was there for them.
And Matt, I would add that when we talk about the value proposition, of course, with any number of voluntary protection products, we know it can be extraordinary. We know with a product like Gap Waiver, particularly with the hurricanes that hit the South during the hurricane season, the hailstorms, when vehicles are totaled, it can be enormously valuable, particularly to consumers who cannot self-insure. And the concern we've always had is that type of information is not enough in the public domain. So John makes a compelling case for the value of the product, and many others would be able to talk about other products and just how useful and beneficial they can be. Oftentimes, however, when you read articles or this is discussed, or even an agency will put out educational material, they take the view that these are gratuitous, unnecessary, there's no reason you want to purchase them. And of course, that just flies in the face of the facts and the experience of many in the industry that have seen otherwise, and certainly many consumers. So it is incredibly important from a public policy perspective that the type of things that are being discussed here be put in the public domain, that we explain the value of these products, their optional nature, and they can be extraordinarily useful in protecting consumers.
That's both great points. And even, we saw from a survey the University of Michigan did just 3 years ago how happy consumers are with some of their credit insurance products. And 85% thought that credit insurance was a good idea, and 70% of those who had purchased it even indicated that they would purchase it again. So there's clearly a disconnect between what we hear from the advocate groups and what the consumers who have purchased them themselves are saying.
Couldn't agree with you more. I think proof's in the pudding here, and what consumers, if they have a choice and they know what's best for them. And when you're talking about credit insurance, what's I think very beneficial is its size to the loan obligation they're taking on. So it's not like they're taking out a $2,000 loan and they're then sold $200,000 worth of insurance. No, this is priced and sized for the risk they're taking on. So for consumers, it's filling the specific need they have. And if you're looking at a roadside assistance or a vehicle service contract or products that protect your cell phone, they're all designed to address very specific needs and concerns and protect the assets that consumers rely on daily.
And we frequently see articles come out, even by many of the proponents for changes in this area, where they talk about how consumers, most of them, cannot absorb a hit of, say, $400, $500, $600, or if they did, it would create enormous economic strain. And we know that many of the losses we're talking about, certainly as it relates to extended service contracts and gap waiver, can far exceed that amount. They can be many multiples of it. And so the notion that a consumer would want to budget against that risk to try to ensure that there's not something unexpected that's going to create financial hardship is obviously a rational decision. But again, the way it's often presented, you do not see that perspective provided. So again, in the public policy domain, whether it's before legislators, regulators, at the federal or state level, or the media, these are just points for us to all drive home.
Let's move on to some of the compliance challenges that the industry faces when it comes to voluntary protection products. We'll start with Paul. What are some of the issues that auto dealers deal with on a regular basis?
Well, I think if we look at enforcement actions and we look at some of the attacks, for example, if you look at that 2017 NCLC report, they really attacked dealer pricing of the products. The words they used was it's excessive, it's arbitrary, it can lead to discrimination. Of course, we hit on a couple of the things before about transparency and the voluntary nature of the product, and certainly you get into refunds. So what we have done to assist our members is to roll out a product for them that we think can help shore up compliance in this area. And I have a few slides to walk us through that if it would be useful. I can pull them up. Let me go ahead and do a share screen here. Great. So what you're looking at here is the product that I'm referring to. This is our model dealership voluntary protection products policy. Now, a couple things about it, and then I'll provide a little bit of detail, not too much. First, this was rolled out last year, April 2019. It is completely optional. We do talk about pricing. Anytime you talk about pricing, we have to continuously stress the fact that it's optional. We rolled it out with the other two national trade associations that represent franchise dealers. That is NAMAD, the National Association of Minority Auto Dealers, and AIADA, that represents the import dealers. Of course, we represent both minority and non-minority dealers, import and domestic, but all three organizations rolled out the product. And the idea is, again, to help shore up compliance in this area. So it definitely has a compliance focus, but also from a public policy perspective, it is a very, we believe, useful tool for demonstrating that the industry continuously works towards improvements. John hit on that earlier about some of the more recent steps that have been taken. And this is just one more example of that. Now, in terms of the inspiration for it, it was really the product that you see here, which is our Fair Credit Compliance policy and program. Now, this is something we rolled out, as many of you know, in January 2014, when the CFPB was looking at dealer participation. They were concerned that dealer participation, that is the dealer's portion of the finance charge, what they earn for originating the finance contract, because it can vary from consumer to consumer, they were concerned that some groups could end up paying more than others without a business justification. So to address that, we rolled out this policy, again, with the same two organizations, optional policy, but the whole idea was to come up with an approach to how you price dealer participation. And it was modeled on a DOJ settlement with two different dealers back in 2007. And really, without going into great detail, it's available on our website, but what it really is designed to do is have a dealer who adopts it, and again, I have to stress, in consultation with their counsel, individual dealer decision, but a dealer who adopts it would come up with a standard dealer participation rate that they add to the buy rate, and that is what they offer to all customers. That is where they start out, so you have consistent treatment. But of course, you want competition to still work in the marketplace. So unlike a fixed fee, a dealer that goes this direction could still discount that amount if there is a legitimate business reason for doing so that is documented. And the ones that come up the most often are the presence of a more competitive offer or a monthly budget constraint. That has nothing to do with someone's background, and it explains a pricing variation. And of course, you'd want to document that. DOJ has talked about the importance of that and record it so that you can provide it to anyone who might be reviewing the issue. Now, as we move forward and talk about the product we rolled out last year, it certainly incorporates that concept, but it's much broader, which I'll get to in a moment. So as you can see here, there's really four different elements. The first are instructions for how to complete the policy template. The second is the two-page policy template itself. And then we have two appendices, which I will show. And those appendices are, one is a poster and one actually is a pricing certification form. Now, if you look at the policy template structure, that's the two-pager. It's really three parts. One is where the dealer expresses its unequivocal commitment to transparency and fairness in this area. The second one are all the things you do to implement a policy and make sure that it remains active. It's not just simply adopted. And the third one are a series of duties that an adopting dealer undertakes throughout the life cycle of a voluntary protection product. So the first thing you do is you select a product. Obviously, you select a provider. You want to exercise due diligence in that area. Pricing, this promotes pricing consistency, and I'll touch on that in a moment. Advertising, of course, you got to always advertise in a manner that comports with all federal and state advertising laws. And presentation, and this is particularly important. A lot of the attacks on VPPs are because inadequate disclosures are made. The fact that it's voluntary, it's not required to purchase to get some other product or service. The fact that you can purchase it individually, not just in a bundle. The fact that you're actually disclosing the individual item price, not just the increase in monthly payment. Those type of things are built into a menu so that when you do make disclosures, any concerns about the consumer not having that explained to them in a prominent fashion are addressed. Then, of course, there are some sale responsibilities. We suggest dealers provide a copy of the policy prior to the purchase, just like they review a credit contract before they sign it, or a buyer's order before they purchase a vehicle. A voluntary protection product should be no different. And then cancellation. Cancellation is important. Clearly, it varies quite a bit from state to state. You have a lot of variance between finance sources and VPP providers and administrators. The whole idea here is communication. Make sure you're talking to one another so that the consumer does get the benefit of any cancellation rights that they exercise. And then complaints, of course, if there is a consumer complaint, you deal with it very early. Now, in terms of the appendices that I mentioned, what you see here is a poster that dealers are encouraged to adopt. Again, it talks about the optional nature of these products. And to the right, what you see is the pricing certification form. And again, Without going into detail with it, it simply records instances where a pre-established legitimate business consideration, such as the presence of a more competitive offer, a monthly budget constraint is present. You go ahead and record it, you retain it, you have it reviewed. Again, DOJ has talked about the importance of that. And then the idea here is you have more consistency to your approach, and concerns about arbitrary pricing that is not wed to any particular factor hopefully are addressed. The only thing I would say just in closing on the structure of this is that, I think as we all know, in a 50-state basis, the law at the state level involving VPPs differs very significantly. Certainly the requirements of providers, finance sources also differ. So when you roll this out to 16,000 dealers, it's very difficult to get too granular. So this hits on key points. Dealers are encouraged to build it up even further to the extent it's warranted due to their state law or their contracts with their providers or their finance sources. So that's really how it's set up, and we are very hopeful it will help dealers and more broadly the industry in trying to achieve compliance and give us something that we also can explain to regulators is an industry tool for trying to strengthen concerns that have been expressed in this area.
That's great information as to the steps you guys are taking, Paul. And John, on the provider side, what can be done to improve coordination between the providers, the retail sellers, and the finance stores?
All right, on this one, I'll swerve back to credit insurance just to tee it off. So I'll step back a little. As a product provider, we do VSC and GAP products, and we do cell phone warranties and furniture warranties, jewelry warranties, appliances, as well as credit insurance. So experience across all these platforms, and they're all a little different in the sales presentation. In the credit insurance space, we spent a lot of time over the last few years is really developing a training platform. I think part of the challenge when you're dealing with credit insurance is there's a fair amount of turnover in the consumer finance branches, and you want consistent information provided to the borrowers about the product, describe it accurately, and make sure they follow the Reg Z disclosure. So what we've done is in-person training as well as webinars, things online, and we have videos that people can take a series of videos and walk through to get trained on all these products. They're all a little different. I'll say the video platform's a little easier in the credit insurance space because there's not a lot of variation state to state. But when you get into VSC, that can be modified significantly when you go from one dealership to another, or one auto lender to another, depending on what their preferences are and structure the product. So a lot more customization in that space. So our training is much more tailored to those specific products when you're getting into the VSC.
Okay, and as I think Paul alluded to, and you as well, John, certainly at the state level, it's a bit of a patchwork of laws across borders when it comes to different products. And what can companies do to navigate those challenges more thoroughly and ensure that they're compliant across the states where they are offered?
I think it's important to note here, when you're talking credit insurance, the first thing is, from a compliance side, is to make sure you have the proper licensing to sell it, because you're selling insurance. So in CFPB world, this is the business of insurance exception. So UDEP does not apply to the sales of insurance. So you want to make sure from our, one, you're offering an insurance product and it's been properly filed and approved. So we maintain all those records. So we can tell you and show you, if you want to see it, for every form, when it was filed, when it was approved, rates and forms. But also licensing is important because that's your step for being in, I'll say, protective blanket of the business of insurance exception. So I've spent a lot of time researching. I've been on the Hill a lot and at the CFPB explaining, and they've agreed that the sale of insurance is not within their purview. So that's kind of step one when you're there. On the kind of the VSC and other warranties, it's really you working with your partner, show that we are required to file those forms in some states. So make sure those approvals are in place, and then just otherwise adequate training to make sure it's adequately and properly disclosed, described, and there's no confusion during the sales process.
Okay, let's spend our last few minutes here kind of wrapping up. And how can we as an industry change the narrative around VPPs? We'll start with Paul.
Well, I think we hit on probably the single most important element, which is explain the value proposition. That is absolutely key. I think internally, in terms of our own compliance procedures, that is equally important. Certainly, the narrative is taken away when the concerns about transparency and some of these other areas are adequately addressed. But another area from an advocacy perspective that we think is critical is to explain the fact that most of these products are cancelable, which is huge. When you think about it, all the concerns that have been expressed about, someone buying a product, they really didn't desire it, or maybe they were having second thoughts, or they think it's worn out its usefulness, whatever it is, many of these products are cancelable in full in the first stage of the contract, and then on a pro rata basis thereafter, which is an enormous consumer protection. My guess is if you talk to most members of the media and many government officials, that may be something that they're unaware of. And yet it should give them a huge measure of relief in knowing that there certainly are self-remedies for a consumer if they have some type of concerns about the product. So I would just sum it up by saying, the value proposition is very important, internal compliance procedures, explaining the nature of these products under the law to include the fact that they are cancelable. Many of those, I think if we can get those type of things across, we can certainly change the narrative.
Yeah, and I would agree with Paul. I think he makes a very good point about the cancellation is an option, and the consumer has, if they change their mind, they're free to cancel them either initially full refund or later down the point on a pro rata. I guess the only other thing is really the stories. If we can do as an industry, the people selling the products as well as providing the products, the more real stories, real life, let it get out of the theoretical and talk about what's this do for real people that need it. So we had the flooding in 2016 in Louisiana around the Baton Rouge area. It wasn't even a named storm. I think 7 million gallons of rain fell over the course of a week. And I know we had $15 million of property claims paid in that one short time frame. So it's real. It helps people when bad things happen. And so we need to tell partly their story of how this helped them and be more of an advocate rather than reacting to broad policy discussions. Say this is real benefits to real people when they need it.
And I would add, Matt, that there's nothing like data to really make many of these points, to include consumer testimonials and other examples of how consumers have benefited from this. During the whole MLA situation with DOD, there was a finance source that stepped forward and provided us data. They had no longer purchased contracts that involved gap waiver. Of course, they had a number of service member clients that still had total loss events where they did have a gap, but in this case, there was no product that was going to waive it. They were in the hole to a significant amount, and we were able to demonstrate with a single finance source the numbers involved and the cumulative liability that they, in essence, had to eat. Those type of things in the form of a bar graph are enormously valuable in trying to demonstrate to regulators that not only are the features we're talking about present in the marketplace, but when you look at just hard data, you will see that these things really provide tangible benefits. And to the extent they're altered, it oftentimes is going to be to the detriment of the consumer. So anybody that analyzes these issues, that has those type of things, it always helps out in trying to tell the story that we're discussing here.
Great. Those are great points. And I think, as you both stated, we really need to emphasize that these are voluntary products throughout the course of the finance contract. From start to finish, they choose to purchase them and they choose to continue with them. And as you both shared, the consumer testimonials really hit home with policymakers. Any final thoughts to share before we move on to our questions?
The only other thing I would kind of add to this is, where are we going? What are the next steps? So, and really, when you're looking at products and innovation, I think in the auto VSC space, we're seeing contracts that cover more of the electronics. Everything from your blinker that now detects a car next to you, and USB ports and navigation systems. So the products are keeping up with the technology as it changes. On the consumer finance space, we're seeing a lot more people with interest in selling voluntary protection products online and or through live checks. So there's innovation within this sector and how products are presented, and I think it's a part of our partnership as we work through and find the right way to do it in a compliant manner, make sure we from our side are compliant with all the insurance laws as well as the laws relating to the service contract. So as things emerge and change, we're there to help people get there.
And I would just say, being an attorney, I'd be remiss if I did not finish on a legal note. And that is, we were talking about how the Truth in Lending Act has given us this branded APR and what a great concept it is, how much it's helped consumers. It's really important to understand some of the other protections that are present. Obviously, we don't have time to go through all of them now, but there's one in particular I would touch on because it gets to items we've discussed. And that is, as a general rule, if you want the premium for a voluntary protection product to go into the amount financed and not the finance charge, you have to separately disclose that the consumer is going to purchase it. You have to indicate the amount of the premium. You have to state it's optional, and the consumer has to sign for it. Usually there's a separate box on a retail installment sale contract that has that information. So the consumer is being presented with information that touches on several of the things we're talking about. That's something that's mandated by TILA, and it's part of existing law. And when we hear that there's holes in the law or there's certain things that do not address concerns, it's important to know what's actually in place and the benefits that it does afford consumers.
Well, thank you very much for this conversation, John and Paul. And I know we have some questions out there from the conference attendees, so we'll move on to our live Q&A.
Thanks so much, panel. That was great as always. Please be sure to select the live Q&A. Find the tile.